Long-term versus short-term investing. The distinction between short-term and long-term investments can be understood in two ways. The definition is straightforward. Any asset that you hold for 1 year or less is considered a short-term investment. The majority of investors keep short-term investments for no more than a few months, if not weeks at a time. Any asset that you own for more than a year is considered a long-term investment. As part of their overall portfolio strategy, most investors retain long-term investments for several years. Knowing when to use long-term and short-term investments to help you attain your goals is an important component of developing your wealth. In this video, I'll show you the advantages and disadvantages of long-term versus short-term investing, and which option is best for your financial future. Welcome to Stocks Galore, the place for those in passionate pursuit of financial freedom. Smash the like button now, subscribe to our channel, and click the notification bell to be notified when new videos are released. A typical short-term investment profile. Short-term investments, as defined above, are financial instruments held for less than a year. Most traders will keep a short-term investment for little more than a few months, hoping to profit from market volatility and short-term gains. While any asset can potentially be a short-term investment, the majority of them will have a few characteristics in common. They'll usually be volatile assets, allowing the price to fluctuate quickly enough for investors to earn from the asset in a short amount of time. They will have minimal price fluctuations in most cases. Finally, a short-term investment will typically be extremely liquid, allowing investors to easily sell the asset. Stocks, options, and exchange-traded funds, ETFs, are all volatile assets with established markets that allow for quick sale. Day traders and active traders, in particular, frequently maintain considerable short-term stakes. A typical long-term investment profile. Financial instruments that you retain for more than a year are known as long-term investments. Most traders keep these investments for several years, putting them into portfolios with specialized strategies like 401ks, education funds, and long-term savings accounts. Any asset, including short-term investments, can be a long-term investment. Long-term investments, on the other hand, increase value slowly but steadily, making them preferable assets to retain for several years. Illiquid assets are frequently held by investors as long-term investments. Real estate is the most prevalent long-term investment. Many people purchase homes as an investment to hold for years, if not decades, enabling the property to appreciate in value. The process of purchasing and selling a house, which is relatively illiquid, would make this a challenging short-term investment, but it would be less of a problem over time. Many mutual funds and bonds are also frequent long-term investments. Most retirement accounts and education funds use long-term investments, which are portfolios that trade seldom and rely on long-term gain. The roles of short-term and long-term investments. In a portfolio, short-term and long-term investments play various roles. Among the more prevalent strategic differences are volatility. Short-term investments tend to favor riskier assets than long-term investments. While volatility isn't always a good thing for long-term investments, short-term traders usually rely on it to make money. Movement on a smaller scale. Short-term investments are more likely to seek out positions with lower gains or losses than long-term investments. A trader has less time for a short-term investment to recoup any lost value. Therefore, they prefer to invest in safer products that will generate profits in the near future. Traders that retain short-term positions tend to make more frequent trades in order to compensate for lesser gains. Day traders are one of the most common exceptions to this rule. They are more likely to seek for high volatility swings, capitalizing on quick price changes in an asset over a short period of time. Aggressive, because long-term investments can bear losses better than short-term investments, they can be more aggressive. An investor who intends to retain a particular item for several years has plenty of time to recoup any lost value, which is common with aggressive or hazardous purchases. This type of inaccuracy has a lot less place in short-term investing. Active versus passive investing. Short-term investments are common among active investors. These traders ship their products frequently, making their assets, by definition, short-term investments. Passive investors, on the other hand, tend to buy and retain their assets for extended periods of time. By definition, this means their assets are long-term investments. Immediate goals versus horizon goals. Investors typically select investments depending on their objectives. Short-term investments are typically held by investors with immediate objectives. Professional traders, for example, frequently retain short-term assets if they rely on the earnings generated by their trading. The investor's objectives in this situation will seek to earn money within the next week or month. Other investors may wish to increase the value of a vacation fund or save for a more luxurious vehicle. All of these holdings will most certainly expire within the next year. Thus, they'll mostly be made up of stocks, options, and other short-term investments. Then there are those who have horizon goals in mind. These are investors that are putting money aside and trading for the future. Retirement funds and, increasingly, savings for a down payment on a home are examples of horizon goals. This position will not be closed out within the next year by an investor. Instead, they plan to keep this portfolio for a long time. Long-term assets that expand over time are commonly used to fill that portfolio. When should you choose long-term investing over short-term investing? Long-term investments are ones that you know you'll keep for a long period of time. Long-term investments, according to Wendy Leibovitz, Vice President of Fidelity Investments Fort Lauderdale Division, are assets such as stocks and real estate that you want to maintain for a long time. They allow you to expand your portfolio because you know you won't need the money for a long time. Here are some occasions where long-term investments are preferable to short-term ones. Your retirement is 20 years away. If you're approaching retirement after more than 2 decades, you still have a long way to go before you quit working. Long-term investments, such as equities, are a good asset class to create wealth over decades because they require time to grow. You have more room to make mistakes and time to recover from market downturns when you're younger, Leibovitz said. Investing in stocks can help you generate wealth for the future. As you approach retirement, you can adjust your asset allocation to include different assets. You'll need a plan for the next 7 to 10 years. According to David Stein, a former fund manager and author of Money for the Rest of Us, another factor to consider is your timeline. Low and medium risk portfolios are common in financial strategies for the next 7 years. However, once you're in the 7 to 10 year range, you'll want to examine riskier investments, according to Stein. In general, long-term assets like equities can be used for money you don't need for a longer length of time, Stein said. It's critical that you stick to your schedule. Stein said that you think about when you might need the money and that dividend stocks are a good option for medium-term goals that can benefit from regular dividends as well as growth possibilities. You like to be protected from inflation. Long-term investments may also be preferable if you want to beat inflation or be protected from it. Long-term investments, such as stocks, are frequently regarded as less safe than other assets, but they offer a higher potential rate of return over time, giving you a better chance of preserving your purchasing power. Another long-term option, according to Stein, is to purchase I-bonds. These are treasury bonds with a set rate of return that also keep up with inflation. These bonds are typically meant to earn interest for 30 years, however you can redeem them sooner. The interest rate on an I-bond is made up of a fixed rate and an inflation rate. When should you choose short-term investments over long-term investments? According to Leibovitz, short-term investments are those that you expect to use to achieve financial goals in a shorter time frame. Rather than building your portfolio, you may require the funds to provide a steady source of income. Bonds, cash, and annuities are examples of short-term investments. Here are some occasions where short-term investments make sense. You're well aware that you'll require funds soon. Short-term investments may make sense when saving for shorter-term goals, such as a down payment on a home. Certain MEC accounts, for example, can offer a guaranteed rate of return, although a low one in most circumstances, as well as the ability to withdraw funds whenever you need it. In general, these types of assets are considered less risky, Leibovitz said. You can keep money in a money market mutual fund or short-term bonds and reasonably expect to access that money for a shorter-term goal without fear of a market loss. When it comes to liquidity or your ability to access the money you've invested, market loss is a big impact. When it comes time to withdraw your money, you may lose money if you choose a volatile choice like stocks. Though bank accounts provide consistent returns, those rates may not keep up with inflation in some situations. If you need money quickly, but want to make returns in the meanwhile, a CD ladder is another choice. Before you deposit your money, however, familiarize yourself with your bank institution's withdrawal policies and penalties. If you want to close your CD before the end of its term, some banks, for example, may ask you to forfeit some of your earned income. You're looking for a consistent source of income. Short-term investments are frequently linked to a steady income. When you know you'll need consistent income, investing in high-rated bonds and other assets can help. While the return isn't as high as it could be with some stocks, you have a better chance of dependable income. Annuities may fall into this category for some, Leibovitz remarked. While the appropriate contract isn't for everyone, it can provide you with regular money for short-term needs. Annuities, on the other hand, offer their own set of advantages and disadvantages. They can, for example, give lifetime income, assured growth for fixed-rate annuities, and tax deferment, but they often come with exorbitant costs, surrender charges, and can result in tax complications. Important key points to remember. When establishing an investment strategy, you must evaluate both long and short-term objectives and select investments that match your goals. Finding the right balance is crucial to building a portfolio that works for you. Long-term investments are ones that allow you to expand your portfolio and achieve your objectives over several years, if not decades. Short-term investments are intended for short-term aims and can provide access to returns that are considered safer. In your portfolio, you should have a balance of long-term and short-term assets. So there you have it. If you enjoyed this video, smash the like button now and subscribe to our channel to be notified when new videos are released.